Welcome to my rapidly growing YouTube channel. I will be talking to you today about some strategies that the Federal Reserve uses to fight recessions. So, sit tight and listen till the end of the video. For a chance to win a $50 gift card, please subscribe to my channel, hit the like button, and leave a comment below. The Federal Reserve, the United States Central Bank, has a twin mandate: to work for low unemployment while also maintaining price stability across the economy. Unemployment rises during a recession, and prices sometimes decline in a process known as deflation. In the event of a severe economic downturn, the Fed may take drastic measures to reduce unemployment and boost prices, both to fulfill its conventional purpose and to offer emergency support to the financial system and economy of the United States. Some businesses fail at the start of a recession, usually as a result of a combination of genuine economic shocks or economic bottlenecks caused by the incompatibility of production and consuming activities caused by previously distorted interest rate and credit conditions. These companies lay off employees, sell assets, and occasionally default on debts or even go bankrupt. All of these factors put downward pressure on prices and the availability of credit to firms in general, potentially triggering a debt deflationary spiral. Deflation, in the form of lower prices, is neither a bad thing for the economy or a problem for most firms and consumers in and of itself. It is, however, widely dreaded by central banks and the financial sector, particularly when it comes to debt deflation, because it raises the real worth of debts and therefore the danger to debtors. In any contemporary economy, banks and related entities are often among the greatest debtors. The Federal Reserve will not hesitate to take measures in the cause of stability to keep its constituent banks from defaulting on their overextended debts. In order to achieve these goals, the Federal Reserve uses a variety of methods to try to re-inflate the economy during a recession. We've divided these tools into 4 categories, which we'll go over in depth below. The first strategy is open market operations. In exchange for freshly issued bank credit, the Fed can cut interest rates by purchasing debt securities on the open market. With their hands full of new reserves, the banks that the Fed purchases from are able to lend money to one another at a lower Fed funds rate, which is the rate at which banks lend to one another overnight. The Federal Reserve believes that a decline in interest rates will extend across the financial system, lowering rates for firms and individuals. When this strategy works, lower rates make borrowing cheaper for businesses, allowing them to keep going deeper into debt rather than defaulting or having to lay off workers. When a recession strikes, this helps to keep employees in their current occupations while also limiting the growth in unemployment. Consumers can make more purchases on credit with lower interest rates, keeping prices high and allowing them to go further into debt rather than living within their means. When it comes to quantitative easing, the Fed buys largely Treasury securities in its regular open market operations, but it also buys other government-backed debt. Interest rates cannot fall any lower at times because banks keep the newly injected reserve credit for their own use as liquid reserves against their debt obligations. In these situations, the Federal Reserve may simply maintain open market operations, buying bonds and other assets to inject new credit into the banking system. Quantitative easing is the Federal Reserve's direct purchase of assets in order to infuse more money into the economy and grow the money supply. Since 2008, the Fed has used quantitative easing on several occasions, most recently in March 2020, when it announced a $700 billion quantitative easing plan to shore up the financial system's debts on top of the nearly $4 trillion in quantitative easing it created during the Great Recession, which it has yet to unwind. It's unclear where the Fed's ability to continue pumping trillions of dollars into the system to protect the banks reaches its limit. The second way the Feds fight recession is by lowering capital requirements. The Fed can regulate banks to guarantee that they are not forced to keep capital on hand in case of debt redemption. Historically, the Fed was responsible for ensuring that banks had sufficient liquid reserves to meet redemption demands and remain solvent. During recessions, the Fed may also relax regulations to give banks more leeway in running down their reserves, even though this increases institutions' financial susceptibility. The Federal Reserve does not now mandate banks to retain any minimum reserves against their liabilities, yet many banks do so nevertheless. However, during the financial crisis of 2007-08, the Fed's quantitative easing campaign resulted in banks retaining enormous ongoing reserve holdings in excess of the statutory reserve ratio. Because of this, the Fed abolished all reserve requirements for banks as of March 2020. This effectively eliminates the Fed's ability to utilize this weapon to ease lending conditions in preparation for the impending recession. The third way the Feds fight recession is by lending at a discount. Through what is known as the discount window, the Fed can directly loan funds to banks in need. Historically, this type of financing was done as a last resort emergency rescue loan for banks that had exhausted all other choices, and it came with a high interest rate to safeguard taxpayers' interests due to the hazardous nature of the loans. In recent decades, however, the Fed's discount lending policy has switched to making these riskier loans at considerably lower interest rates in order to favor the financial industry as much as possible. It has also launched a slew of new financing products, akin to discount lending, aimed at bolstering specific sectors of the economy or specific product pricing. The Federal Reserve cut its discount rate to a historic low of 0.25% in March 2020, allowing the riskiest borrowers to take advantage of extremely favorable terms. As the economy continues to deteriorate, it may be impossible to reduce this rate any further. The Fed is acting as a lender of last resort for banks by providing discount financing. The fourth method is by management of expectations. Forward guidance is another name for expectations management. The influence of market expectations in the financial sector and the economy as a whole is acknowledged in a lot of economic research and theory on financial markets and asset prices, and the Fed is aware of this. On top of the genuine challenges facing the economy, uncertainty about whether the Fed would move to bail out banks and keep asset prices inflated can lead to pessimism among investors, banks, and companies. The Federal Reserve is presently using all of its expansionary monetary powers. It now has to moderate expectations about the magnitude of the freshly produced money and how long it will endure. During recessions, the Fed often tries to reassure market players by its actions and public announcements that it would use the measures outlined above to avoid or cushion its member institutions and the financial system from experiencing excessive losses. However, with the Fed funds rate, discount rate, and required reserve ratio all at or near zero as of March 2020, the Fed's ability to engage in unlimited quantitative easing for the foreseeable future appears to be critically dependent, barring the introduction of new and even more non-standard monetary policy. I hope you find this information helpful. To get more contents like this, kindly check out the video suggestions on your screen. You can also look through the playlist for more content that you may like. For a chance to win a $50 gift card, subscribe to my channel, like the video, comment, and share. Thank you.